Hello and welcome to our special show, Restarting India. I'm Lata Venkatesh. Well, the key trigger for this restarting theme that we have today is that Reliance Group, India's largest income-generating private sector company, as well as one of the largest employers, over the weekend announced that it is reversing earlier pay cuts with retrospective effect, which actually spells a bonanza for employees, 3.5 lakh employees ahead of the festival season. Then we have other good news that's also come in a little earlier. IT companies have said that they will start giving increments from Jan, some even earlier. Banks have already announced pay hikes, usually mostly private sector banks. And then we had last week government employees getting LTA advances, 3 times the LTA amount provided it was spent on consumer durables. Now, economists say all this put together could get a consumption boost. Well, will this mean that we could see a faster than expected recovery? Is anyone already trimming the fairly dire GDP forecast that we got at the end of August? For all those questions, I have with me a diverse group of analysts and experts, actually. I have with me 2 economists, Indranil Pal, the chief economist from IDFC First Bank, and DK Joshi, the chief economist at CRISIL. I also have with me Anandaroop Ghosh, who heads HR or HR-related services at Deloitte India. Gentlemen, thank you very much for joining me. Well, let me come to someone who is clearly looking at pay and pay scales and increments. Anandaroop, you put out a report on August 24th, and details of that report will flash by as you speak. Over there, you said that this year, India Inc. may give an increment of only 3.6% compared to 8.6% last year. Do you have any reason since August 24th, I mean, we are 2 months thereafter, do you have any reason to revise that number upward?
Yeah. No, actually, that's a fair point. What's been happening from then on? So if you look at the report basically says 3.6% taking into account zeros, which is all the companies that were giving 0% increase for this year. Now, what you're seeing in the last at least a month or so is more and more companies are making that zero into a positive number. So naturally, the 3.6 will go up. Broadly speaking, I think the expectation is twofold. One is that all the zeros are going up, and all the companies that had not taken a decision or had pushed the decision back by a couple of quarters are now taking that call. So like Infosys, TCS, etc., the companies that you saw. So I'm guessing, while there is no clear number around it, but it's safe to assume that the 3.6% would go up by about 100 basis points or so when we eventually take account at the end of the period.
Okay. I just want to highlight Deloitte's study highlights are flashing for you on the screen. Deloitte points out that companies that said they're giving an increment, the average increment was 7.5, but the average fell to 3.6 as of mid-August because there were a lot of companies which had not taken a decision. Well, another question to you, Anandaroop, before I go to the economists for the more economy-wide picture. What is the incidence of people restoring pay cuts? I mean, I'm not talking about increments. I'm talking about people who have restored increments, restored pay cuts, and those who have restored pay cuts with arrears paid. Because that seemed to stand out in the case of Reliance, that they're going to pay back. So, assuming that's a 20% pay cut for 5 months, it would mean an additional salary actually for a person in the month of October, along with the October salary, 5 months of arrears. How many people in your reckoning are just restoring the cuts, so you're coming back to status quo ante, and how many are actually paying the backlog?
So actually, just to step back again to that study that you were referring to, in that we had said that there was a third of companies in that study, only a third of companies in that study, who had said that they are making the pay cuts for an undefined period of time, whereas the balance 67% had said it's for a 3, 6, 5, whatever the number of period of months for which the pay cut would remain valid. So what you're now seeing is a lot of the companies that had put a time frame to that pay cut are reaching the end of the time frame and are reinstating the pay cuts. Those who had said it's not for a defined, like it will be ad infinitum. Those are the people who are still not yet taken a decision in terms of reviving their pay cut. From the ones who had said that they're making the, or reinstating the salary cuts, I think it's equally split between those that are doing it with a retrospective effect versus those that are doing it for the period going forward.
Okay, so
I would say it's probably more of those who are saying that it will only be for the next few months as opposed to what has already happened in the last 5-6 months.
Okay. Now let me try and make sense of all this from a macroeconomic perspective. First, you, Mr. Joshi, what are you picking up in terms of employment and salary trends? I mean, we have, of course, only the CMIE numbers, but if you have any other lead indicators, how is the employment picture looking and how is the income picture looking? Would you want to revise your forecasts from what you had earlier? I think you had -9% when we last spoke.
Well, I think clearly there's no doubt that the economy is seeing a rebound right now, which was faster than we expected. I think it's a result of opening up of the economy. There was a pent-up demand which is getting met right now, and the rural economy doing somewhat better than the urban part. So clearly, I think so there has, and this kind of a pickup has been seen in other economies as well. But I think I would just want to, and as far as the wage bill is concerned, I think wage bill as a percentage of overall expenses of the companies, I think if you plot it till whatever data we have, maybe if you look at the first quarter, clearly it came down very sharply. And I think that will be somewhat restored. And I think the larger companies we all know are doing much better right now. And I think there is even the margins, I think, are improving in some cases. So clearly, I think, but before we read too much into this, I mean, I would definitely say that the second quarter is looking somewhat better than what we expected. We expected -12%. I think as of now, I think it looks much more than that. But let me, I think, come in here with the fact that the virus and the economy, I think in other countries as well, apart from those countries which have virus under control, I think in other economies we are seeing that it is it's a non-linear path. I mean, so in such a situation, you cannot linearly extrapolate the trend. I mean, when things are looking down or things are looking up, you're bound to go wrong. So there's little surprise that the forecasts have been unreliable. And coming back to India, I think what we clearly see is that things are improving now, but at the same time, the economy is also opening up, and that typically tends to increase the virus caseload. As it is happening in Europe or as it's happening in US, whether that will happen or not, I can't predict that. I think going by what's going elsewhere, I think there is a chance that we could get a second.
Okay, so I'm getting two key takeaways from you. One, that the second quarter is a lot better or not as bad as you initially thought. And your second takeaway is that growth will not be linear. So just because second quarter was better than you expected, we cannot extrapolate it to the third quarter simply because we cannot forecast how the virus and hence economic activity will progress. I take your point on that. But other things being equal, if we don't have to speak about the virus and only speak about the lagged data, how much better than you feared is the economy in the second quarter?
Well, I think we have not. We're still waiting for some more information because the data is not available for all the parameters as of now for the month of September. I think the moment we get these indicators, we'll try to reassess the economic performance. As of now, I can't give a number because. Okay.
But the delta is higher, you think?
No, I
mean, will you give it a what do you call it? Positive bias?
Well, I think I would say that it could be better than -12%. I think that
you had.
Yeah. Okay. So that's all I can say at this point.
I can imagine. I don't want to tie you down to a number which you have not yet modeled. Indranil Pan, a similar question to you. How has September and October panned out for you? And do you suspect you will have to revise the numbers higher, that is less negative?
Well, we were anyways better than even what the RBI was indicating and the multilateral agencies were at. We were at negative 8.7% for the year as a whole. Now, having said that, I think, yes, there are certain isolated cases, as you pointed out, in terms of salary increments having happened. But I think what I'm more bothered about at this point in time is what is the distribution of the additional GDP across the economy, in the sense that if we are continuing to talk about supply chain disruptions having happened, obviously there has been job losses on that segment. While we keep talking about these headline numbers, such as the RIL and certain private sector banks, as you mentioned, which has provided a higher salary. Now, looking at this situation, I think one of the bigger bigger point where I might actually turn my GDP around a little faster than what I would have otherwise expected is if I see the deposit growth rate coming down and if the credit is going up. So I think those are the very two critical factors which I would be looking at in the current cycle to determine whether the consumption is taking a hold on the economy once again, and backed by the, or front-led by the consumption, whether investments or private sector is ready to invest in the economic journey going ahead. Now, the other point that DK also made is very important. We have just ended the first phase. We are feeling very positive about it. We would want to see whether we are hit by this second wave, which most of the European countries have been hit by. Spain, in fact, went into another round of lockdown. US is being hit by the third sort of phase. And those are the elements that we need to look at, because any further spread of this virus and any further quasi lockdown, even for the Indian economy, can actually turn out to be disastrous, simply because we don't have adequate room in terms of either the monetary policy or the fiscal policy.
Oh, okay. No, I take your point. We are not experts in forecasting how the virus may behave and therefore how the lockdown may behave. Gentlemen, I have to take a break. I want to come back and ask you more questions on, how you are estimating consumption to grow, going by the nature of response for festive season sales, for instance. The anecdotal evidence we have in terms of auto sales or in terms of consumer durable goods and their numbers. We've got some extraordinary numbers being reported by Nestle. We've also seen companies like Nestle announcing capex, which they are, which one doesn't normally hear of. Some cement companies to have announced. So all those questions in terms of anecdotal evidence and what are they pointing out to in terms of a recovery, to my guests in a minute after this break. Reliance Industries announced that it is reinstating salaries that were cut in the month of May, and it is paying entire arrears. Over the week, we also heard of IT companies agreeing to pay increments, and as companies announced their numbers, private banks also said that they are going ahead with increments as planned before. So we are asking two economists and one expert from Deloitte whether one can see a difference on the ground, and whether GDP forecasts, which have so far been around minus 10% for a broad swathe of forecasters, is likely to come down to, say, maybe minus 8 or minus 7. That's the question we are asking. The two economists are still caveating any changes in forecast. I've been speaking with DK Joshi of CRISIL and Indranil Pan of IDFC First Bank. Anandaroop Ghosh, a partner at Deloitte, who has personally done a survey of increments announced by India Inc. as of August, is also with us. Anandaroop, what is your anecdotal evidence in terms of more recruits? Have you seen too much of job cuts, or have you seen a different kind of industry employ? What would be an overall comment in terms of job losses or job gains?
I have three things here on this, frankly. On jobs, first of all, the formal white-collar jobs, the way we are talking about what we're defining as job cuts in the context of what we study or what we've been looking at. And as Mr. Joshi and Mr. Pan would say, it's a very small part of the larger Indian context. So the white-collar corporate jobs in India are not that many in reality as a percentage of large jobs. Within that also, there wasn't necessarily a very large proportion of job cuts that had happened.
Okay.
vis-a-vis what you saw in 2009 and 2008, 2009 period, etc. It wasn't as deep as at that point, at this point of time, compared to back then. That's one. Secondly, and you talked about this whole thing about resurgence and so on. I think you actually also saw, by the way, on job cuts, that in the larger technology space, technology product companies, some of the ITES, BPM kind of companies, etc. Not only were there no job cuts, there was actually a massive race to hire more people. So it's a little bit imbalanced in that sense. I mean, it's not a one-size-fits-all kind of a picture as far as job
Fair
cuts.
point. Fair point. Let me toss that to Joshi then. Mr. Joshi, what are the latest numbers from CMIE in terms of employment or any other index?
Well, I think we don't track employment that well and don't look at the CMI numbers also.
Okay.
I think if you simply, I think it's not only the issue of employment, but I think as you were pointing out, I think if you have employment at lower wages, that also eats into consumption demand, because the proclivity to save has increased. I think, as Indranil was also pointing out, even with negative real interest rates, I think people are putting money in the bank deposit. So that's telling you that still, I think the uncertainty still plays quite a dominant role. And on top of that, we also have, I think one should not forget, we have high inflation. So I think that also erodes the purchasing power of. So I think these factors do play out.
But Mr. Joshi, 1 minute. You I think also mentioned that the white-collar job is not a large part, but in terms of a percentage of total income, it must be high, even if the number of people are not many, especially in terms of making a difference to consumption. No, what is the?
Well, I think the rich people tend to save more. I mean, in this. During a pandemic, I think that's the experience of US as well. I think the poor people tend to spend more. I mean, because they don't have that kind of a buffer. So that's why we are seeing the savings increase. What I would say that
go ahead.
Yeah, I just wanted to add that I think that our research team, I think at CRISIL, has been revising some of the numbers upwards. For instance, the car demand, I think, is expected to fall only by 12 to 15% for the full year. 18 to 20. So there have been some marginal revisions here and there. And tractors is largely agriculture led. And I think, mind you, I think these auto numbers that we keep talking about, they are over a very negative base of last year. And already I think there is some inventory buildup that is taking place. So you need to be very cautious when you. And even the GST collections, which have gone up very sharply, I think are a result because people were allowed to pay later. So I think they didn't pay it earlier, now they are paying. So I think we need to balance.
So pent up in another sense was evident in GST. Okay, I just wanted a quick word on the savings before I run out of time. Well, actually, bank credit growth for the last reported number by Reserve Bank, 5.7%, is better than perhaps the last 3-4 months. As well, deposit growth at 10.5% is the lowest compared to the last probably 3-4 months. We were, at very close to 12% on several weeks. So, Indranil, of course, one swallow does not a summer make, but are there first signs that deposit growth is tapering, is slowing, and credit growth is picking up?
Well, I'm not sure because, again, I think the critical issue at this point in time, especially when we had seen extreme low numbers in most of the variables that we track, obviously savings had peaked out. So obviously, as the economy normalizes, there should be some amount of normalization in these savings as well as credit numbers too. So within the credit, I think the factors that I would track once again is what is the rate of growth of the personal loans. Now, the other thing apart from the growth rate that we track is what is the incremental flow of the bank credit to the personal loan segment, and that probably hasn't done too well in the current year compared to the past year. So I think, as DK pointed out, people are still cautious. If I look at the surveys from the Reserve Bank of India on the consumption side, the 1 year ahead survey does point to a negative bias even today. And unless some of these reverse, I think very solidly putting out a sharp revival story for the economy may not be on.
Oh,
Yes,
no,
they will
that was
not-
never on my cards. No, that was never on my cards when I invited you, gentlemen. My point was, are we going to be a little less negative than we were earlier? And Anandaroop agrees that if the earlier increment number was 3.6%, maybe if a survey is done today, it may not be as bad as 3.6, it could be higher. And DK Joshi also has a hunch that the minus 12% for the second half, which CRISIL has forecast, could be revised a little better. But I take on board your caution that all these are probably a result of pent-up numbers. And there is always the fear that if the global economy goes into a second bout of viruses, as we have heard in Europe and the US, then several other parameters for India in terms of export growth may not also pick up. So we are speaking with caveats, but compared to what we heard last time, it looks like there are some voices of confidence that the economy may come out a little less bad, less hurt than when we last met. Thank you very much, Mr. Joshi, Mr. Indranil Pan and Anandaroop.
Thank you.